You're going to learn how to profit from things that only make most people poorer. This is Get Rich Education with Keith Weinhold.
Well, hello, Get Rich Education Nation. It's Keith Weinhold here. I'm in Scottsdale, Arizona at the MC Company's headquarters with Ken McElroy.
Hey guys, how are you?
You probably already know about Ken. He is the Rich Dad Advisor for Real Estate. He's the founder of MC Companies, where they do a lot of things, but you really thought of as the apartment syndicator. And Ken is also a prolific author. In fact, the last book, did you even know this, Ken, that I read every single page of, cover to cover, was your book, Return to Orchard Canyon.
Oh, thank you.
Yeah. Well, with that in mind, talk to our audience about what you think they need to know today as a real estate investor.
So here's what we're seeing. So we have a couple thousand investors in our various projects. We have about $1 billion worth of multifamily, office, self-storage. So 250 employees. And so we've been raising capital and putting people, high net worth people into deals. And here's what I think the biggest issue most of them have. So our investors are coming to us and they're saying, listen, I have $1 million, I have $2 million. I'm going back and forth. I'm looking at retiring. My problem is that when I stop, I don't have any income because I have a job. And so they're frustrated. So they're like, well, maybe I should keep working. And if I don't keep working, where can I stick that $1 million, let's say? And is it in the right spots? And does it produce any passive income? Because what they're trying to do is replace their income. So if they stop and their paycheck stops coming in and they're sitting in, let's say, a low yielding investment, they're not able to live, and they're going to start eroding, whatever capital that they had in the bank or in investment with an investment advisor or whatever. So that's the biggest thing I'm seeing right now, Keith, is with my own investors, they're looking for things that cash flow.
Yeah, because a lot of people are yield starved. A few years ago, you could invest in a savings account and maybe at least get a yield that keeps up with inflation. But even in the non-brick and mortar online first ones, you can't do that now. So that pushes more money into assets, running up prices, making yield more difficult a lot of times.
A lot more. And that's precisely why we haven't been able to buy at the volume that we were buying. So we have the exact same model, same investors, same acquisition people, same management companies, same markets, and we're getting pushed out of deals because they're getting priced really high because of low debt, and people are coming out of assets, let's say in areas, and they're pushing up and creating bubbles in other areas. And so some of those markets that we're in right now, I think that we're in the bubbles, but we have to back away or walk away because the returns are maybe half of what we were getting even 10 years ago. And so we're now looking at new markets. But I think the biggest issue is, my demographic and a lot of my friends that are, let's say in their 50s, they're concerned because they don't have cash. Even when I was in my 40s, the little bit of money I had, I wanted it to work for me. And I knew at some point I wanted to have that money working for me so I didn't have to work. Right? I want to work, but I didn't want to have to work because I didn't want to erode that savings account. And what happened was now we have inflation. And so we're starting to see inflation is going to start eroding savings. And that's why we put this up here, is that I think before, Keith, certainly when I was growing up, and my father used to say, they would pay off their house, they would save all this money in the bank, and that was the right thing to do then. And that's what I started to do because I learned from him. And then I was realizing that my savings account, especially in the 70s, I was like, what's happening here? A dollar just from 72 to 84 went down to 40 cents, I think it was. Just from a purchasing power. It's still a dollar in the bank, but it just bought less. And so I was like, okay, I'm going to have to figure this out if I'm going to stay ahead. How am I going to stay ahead of inflation? And so my savings account, thankfully I was a young kid trying to figure this out. So I'm like, I have to invest and figure out and invest in something that rides inflation and something that works with me as opposed to against me.
Right. We're looking for that inflation-adjusted return, that real return, not the nominal return. Nominal means what our return is in name only. If we have a 10% rate of return and 4% inflation, you have a 6% real return and a 10% nominal return. You talked about inflation earlier. The CPI, the consumer price index that the government measures, is pretty low right now, and the Fed's had trouble meeting their 2% target. We can talk all day about how that number is manipulated. But really, when we talk about inflation, the pure definition of inflation is more dollars circulating in an economy. That's what inflation is in this purest sense. But what we're interested in talking about is what affects you, the diminished purchasing power of the dollar. Your Chipotle burrito cost $8 last year, $9 this year. Price inflation that affects you at the consumer level and at the asset price level. That's really the inflation that we're concerned with. And some people think that we have inflationary pressures building, even though they're relatively low right now. You can actually harness that and benefit from inflation as a real estate investor, but your experience with inflation has really just been it's diminished the purchasing power of your dollar, so you're probably thinking of inflation as a bad thing, but as real estate investors, we can leverage that into a good thing.
Yeah, inflation doesn't care. That's the cool part. I mean, it doesn't care if you're saving money or you're in debt. It just doesn't care. It's money. So it does what it does, and you just need to know which side you want to be on. So if you're going to save a bunch of money and we're heading into high inflation, that money that you saved is going to buy you less. If you're in debt, then that money is you're going to pay off that debt. You're going to pay it off with cheaper dollars. So you just have to decide.
So let's imagine that you have a real estate portfolio, might be your primary residence plus your rentals, and just say your entire debt on that portfolio is $1 million. Inflation helps erode and debase that debt for you. So say we have 10% inflation over, it might be more than 1 year, but just 10% inflation over a period of time. Now, after that period of time, you don't owe the bank $1 million real dollars. You only owe them back $900K in inflation-adjusted dollars. You just got an inflation profiting tailwind because you tied up long-term fixed interest rate debt. And you know what's interesting, Ken? A lot of people, when I tell them about that, they say to me, well, what do you mean, Keith? What about the interest payments on that debt? No. In a cash-flowing rental, your tenant pays the entire interest payment for you, plus a principal payment for you, plus hopefully a little on top of that called cash flow. So your debt is therefore outsourced to the tenant. So just like inflation debases your lump of savings, similarly, it debases your entire debt amount. That is a good thing.
Right. And this is what so one of the things that I've been predicting is I believe that the reason the Federal Reserve lifted the 2% target and said it might be a little more, if you go back and look, you're going to see in the 70s and 80s, inflation was all over the map. It's just been 2%. In a lot of people's lifetimes. But if you go way back, like when I was a kid, it was a lot higher. And so what I think that they're going to do is now that they're spending all this money on this CARES Act and they're spending all this money through this financial stimulus, and we got trillions and trillions of dollars going out, and potentially even UBI or universal basic income, all of that stuff, potentially, then the one thing that will lower that is inflation. So if inflation is unleashed, then that debt, the government debt or your debt, it's the same. It's going to be paid off in cheaper dollars later. So they could deflate their own debt with inflation.
It's about really, I think you're talking about aligning your interests as an investor with what the government's interests are. The government has $27 trillion in national debt, so they should have an interest themselves in debasing the dollar. It makes them easier to pay back their debts with these diluted dollars, just like it would you and yours. You don't have to like what the Fed's doing, you don't have to agree with what they're doing, but if you align your interests with what they're doing, you can be a profiteer.
Yeah, Tom Wheelwright, one of my good friends that talks a lot about tax, I said, the tax code is so confusing. He goes, it's actually not. He goes, all you got to do is see what policies are being passed and then follow the line. He goes, the government basically tells you where they want the tax dollars to be put. So whether it's housing or whether it's oil and gas or whatever it is, it's the same thing here. The government's going into debt, and what's the best thing is for them to be able to erode their debt with inflation over a period of time. So if you have that same mindset yourself and you go into debt, good debt, not bad debt, then you can do the exact same thing. And you're actually riding this wave exactly just like the government's doing at this very moment.
And good debt still perplexes some people. I can think of a couple cases of good debt. Number one, I sort of touched on that. When your debt is reliably outsourced to a tenant, meaning you have a conservatively bought cash flowing rental, that's good debt. And the other way is when the interest rate that you pay on debt is the same or less than inflation. Before we started chatting here, I brought up the point that now that mortgage interest rates are about the same as the long-term rate of inflation, if you buy a rental, even if it had zero cash flow and it broke even, you still would not lose money over 30 years, even if the property doesn't appreciate, and even if it didn't break even, because that's how low interest rates are now. And I like to say, debt is maybe my favorite four-letter word.
Yeah,
this is why maybe the word loan is my favorite four-letter word, somewhere in there. So get in love with debt, the right kind of debt. You really can profit from it when you do it right.
So guys, if you lock your loan at say 2.5% and inflation goes up to say 4%, you're in the money. Basically your inflation is it's actually better to inflate this because you're borrowing at 2.5%, right?
Yeah. Well, I talked about how your total debt amount is debased with that $1 million example. It works similarly with your monthly payment. You only have to make the same principal and interest payment over time on a property. Call that $1,000. Well, inflation makes it easier to pay that back. If you have 3% inflation in a year, in inflation-adjusted dollars, you only owe back $970 a month after year one, $940 after year two, and so on. So it really works a few different ways. You have any last thoughts on inflation, debt, or what a real estate investor really needs to know?
I would just encourage people to take a look at inflation rates over the long haul, because I think they'd be very surprised. I mean, in the last few years, the last 10 years, they've been kind of hovering really low. But even if you were a saver, you were losing, because they were 1.5%, 2%. Your savings rate isn't even close to that. So I would just take a look at that. And then maybe this will all come into perspective for you, and you'll be able to see that it looks to me like the government is going to be relaxing the inflation target rate. And so this is a good time to get in fixed rate debt while that happens, and then you can ride with the wave with them.
Ken, where's the best place for people to find out more about you?
www.mccompanies.com. That's our company website. Or our learning platform is www.kenmcelroy.com. Those are both great examples, and you'll get to me either way.
Ken's an excellent teacher. I've learned a lot from him myself. For Ken McElroy, I'm Keith Weinhold. Thanks so much for stopping by.